This podcast is for general information only. If you're after advice for your own situation, it's best you chat with a licensed financial advisor. Welcome to the Aurellan Intergenerational Thinking Podcast. My name's Chris DeLeva, CEO of Aurellan. Today I'm joined by two very special guests, one being the Head of Research of Cotality, Nick Goodall, and my colleague and Aurellan's investment principal, Rachel Weld. Look, today we're going to be talking all things property. Property's clearly been in the headlines, and probably not for the right reasons over the past few years. We have seen some softness in the market. And Nick, so, talk to me about that. Property, a favourite for New Zealand investors. Struggled recently, but maybe take us through what's the journey looked like over the past 10 years for residential property investors.
Yeah. Look, firstly, thanks for having me, Chris. Great to come on the show. I think it is an interesting one, right? Like through that 10-year period, the market's been through a lot. We did see some growth come back into the market prior to what really took off in COVID times, of course. We did see exceptional growth through COVID. Much of that did decline once again following COVID, and interest rates came back up again. And I think what's been really interesting in the more recent times has been values have essentially gone flat for 3 years. And in all of that time as well, we've had some pretty different and big regulation change. When you think about for an investor, we've had things like the bright line test changing, which is when they have to pay capital gains tax with selling between a certain period. We've also had the taking away of interest cost deductibility and then bringing that back in again. And so I think there's been some positive change for investors in the last few years with the current government, but not all has gone their way either. Right now, we're actually seeing rents decline, so yield is not exactly growing that much at the moment, and all these costs are affecting investors too. So those mortgage top-ups were pretty big. They're still there, but they're certainly improved on where they were recently. And so we're starting to see investors come back, but it's more gradual than what we've seen in the past, where they've, had a pretty good time at buying property over the previous couple of decades.
Yeah, and look, talk to me about that peak in 2021. I mean, we were in a really weird time, right? Like I just remember managing diversified portfolios, you'd look at the bond yields and they're, pretty close to zero. And that, falling discount rate and very low cost of debt, it kind of just meant there was an everything bubble, right? And we certainly had that in property. So talk to me about today, where are we compared to those peaks that we saw in 2021? Yeah,
as you say, it's hard to even look back and remember how crazy those times were. We had annual growth of 30% one year, upwards of 45% in some places over that sort of 18-month period. But we did see the significant decline. And that decline now shows us that nationwide, we're about 17 or 18% below that peak of the market at the end of 2021. In some parts of the country, like here in Wellington and in Auckland, almost 25% down on that peak as well. So we really haven't seen that growth come back at all. And anyone that bought at that time are still feeling pretty rough, right? Like they haven't seen growth in their property. They've seen a decline. If they bought at that time, they certainly, some of them might even feel like they're in negative equity as well. So it's definitely been a big change and a massive adjustment for people. And I think that also leads to now people's expectation on what the future might hold, that, the property market doesn't always go up. And so it's just changed that mindset slightly too, which means people are a bit more cautious about things at the moment.
Yeah, and that feels almost quite generational, doesn't it? In the sense that, I know growing up, the aspirational thing that my parents would tell me is, get into your first home and get that rental property. And there used to be the psyche that get in there and, and then it'll just pay itself off. I want to ask you a bit about yields later because I don't quite think that's the case in many places at the moment. But just talk to me more broadly about property kind of as an asset class, right? We know what's happened here in New Zealand. Is this a New Zealand thing that we've seen, price falls of this magnitude, or are we seeing property fall out of favour in Australia as well?
Yeah, I think the comparison to Australia is interesting because in general it's quite similar. The more recent trend has been quite different. That's mostly based off the back of a stronger Australian economy where they've seen continued growth. Their labour market is more robust, more broad-based, and it's a higher wage economy. So in the last few years their economy's done better, and so they've seen that flow through to a better performance in the property market. I think in general with that psyche, we have changed a little bit. There's no doubt there's still appeal of residential property. You can leverage to get into it. As a home yourself for a roof over your head, there's still strong appeal. You can change it, you can physically touch it. And we've seen really strong first home buyer activity, which shows that people still want to own their own home, but that flow through to investment property has certainly slowed down. I think that is due to the appeal of property slowing down, the expectations of growth reducing as well, but also the options to invest, to see your retirement grow over time, to have other options has also grown. You know, whether it's smaller portfolios through the likes of Sharesies and Hatch, or it's through the larger investment companies which are more available to people as well. So I do think we've been through a big change. It's not just New Zealand, but maybe it's hypersensitised here because we have been so obsessed that any change has felt a bit more acutely.
Now, look, I'm just going to say that we have the founder of Invest Now, who's a co-founder of Aurellan. So they were another great place to have easy access to a portfolio. Just so Anthony doesn't watch this and chastise me. Hey, Rach, look, I mean, you've got a really broad experience in global property, being one of the original founders of Resolution Capital. Looking globally, what have we seen over the past decade in global markets, and have they been soft like they are here? And I know globally you cover and know beyond residential, so feel free to tell us, what's going on in office, industrial, and other areas.
Yeah, there's no doubt that real estate globally has been going through a tough time. You've seen commercial real estate values fall between 10 and 20% from its peaks, the pre-COVID peaks. However, if you look through the last 25 years, and we're long-term investors, you look at the global listed REIT market, that has actually returned 7.2% on an annualised basis. So that's somewhere where you'd expect property to sit, somewhere between bonds and equities. So it depends on your starting point. You've seen quite a lot of sector changes within the listed sector. You've got huge growth from data centres, industrial, housing, senior housing in particular, is now making up a larger percentage of the sector, and that's at the cost of office property.
Yeah, and office is an interesting one, right? So, talk to us a bit about that. In the midst of COVID, it was really like office is dead. People aren't coming back. People are going to work from home. But I think actually as we've gone through that, particularly in Wellington, right, we've actually seen the impact that can have on a city. You get thriving suburbs, but you actually get a central city that's pretty dead. We feel that more than most in Wellington, but I can say my home suburb of Island Bay, where I first met Nick, that's thriving because of that work from home kind of thing. So what are we seeing globally around office?
There's a pull to get people back into the cities, definitely. And there is starting to get good demand for high quality office space that's located well in a sustainable building. The poor quality office space is definitely suffering, but that well located property is doing pretty well, and you're starting to see rental growth.
So look, Rachel, talk to me about the current pulse of the sector. Have we seen any transactions that kind of give us a good idea of the health of the global property market?
Yeah, there were a couple of transactions late last year in the shopping centre space where two Westfield shopping centres were sold at cap rates of 4.7 and 5%, which is pretty firm and indicates that retail shopping centres are in demand. There was a time where people believed that that deliveries were going to take over the shopping centre, but they're now becoming more of a social hub and people want to get out of the house. They're a community space. So again, good quality real estate is in demand.
Yeah, that, to be honest, that shocks me, those sub-5 kind of cap rates. Yeah. And just for those of you listening or watching, a cap rate is essentially kind of the return that you'd kind of expect from an asset. So, 4.5%, 5% return in an environment where, cash is 2 or 3 kind of says to you that the sector's probably in pretty decent sort of health. Now, look, I feel like we've got a good sense of kind of what the pulse of the property market has been. It kind of feels like if there's a U, we've kind of, taken the lift down and we're hovering somewhere in that, bottom part of the U, maybe the middle to the end of it. So let's kind of start thinking on a bit more forward-looking basis. And Nick, I reckon you'd probably get this question about 3 times a day. I bought in 2021. When's the price of my property going to start going up? What's the outlook for 2026?
Yeah, I think the good news from that perspective for someone that is hoping for that growth to come back, that we do expect some growth to come through this year. It's probably pretty slow growth, maybe upwards of 4, maybe 5%. But for me, it's all dependent on the economy. If the economy starts to thrive and we see that GDP growth come through, then we'll likely see some flow through of that to the property market. Equally dependent on the employment situation and the labour market. Today, we literally just got the data from Stats NZ about unemployment, which did rise last quarter, which is not a good news story from a labour market health perspective. One thing it might mean is that interest rates do stay lower for longer, if that means some downward pressure on inflation. So for any current mortgage holders, that's probably a good thing for them too. But of course, anyone that's in the job market, they want that certainty. The better they feel, the more likely they are to spend in the economy, and then we'll start to see that activity translate into the property market. One of the groups of buyers we've been watching quite closely and saying for probably 2 years, when they come back and it's these movers that haven't moved house but maybe would have wanted to because their life stage has changed, they've held back from the market a lot lately. But as their job certainty improves, the economy starts to increase, we expect them to come back out of the woodwork, and that'll start to drive some activity and some upward pressure on prices, particularly in a section of the market that hasn't been going so well, which typically is that sort of, depends on the city, of course, but in that next home buyer part, which might be in between $1.2 and $2 million, depending on where you are in the country. That part of the market has certainly been struggling, whereas the lower end, where first home buyers and investors buy, that's been a bit more healthy more recently. So for the whole market to gain momentum, we expect it's based off the back of the economy, but we do expect that to mean more transactions this year, up to around 100,000 residential property transactions, and maybe about 4% value growth to come through this year.
And Nick, really interested in kind of understanding, within the property market, how much do you think of it's kind of self-reinforcing? And I'll give you a really good example. If you think back a few years ago, there was a consensus that the US economy would fall into recession, right? But their share market was actually really strong and firm and kept gaining, and their wealth effect was really tied to shares. So you can get sometimes these self-reinforcing kind of mechanisms which can drive markets forward. I use the probably untechnical term animal spirits. When animal spirits come in, you really start to get asset prices kind of just reinforcing on themselves. So, in the property market, how much do you think of it's just that spark, the first 2 or 3% that kind of get people going, okay, property's back, we're a little bit off the bottom. How much of a property market is that kind of animal spirits and self-reinforcement?
Yeah, I think in the past it has been pretty significant. What's been interesting over the last 2 or 3 years there's been a couple of false starts. It's looked like we've seen this growth come through, but it doesn't hold, and actually values declined a little bit after as well. And I do think that the market has changed quite dramatically. Now, whether that's through Reserve Bank restrictions, both on loan-to-value ratio rules, debt-to-income ratios, the government, of course, have had some effect on that too. And so I just wonder if the market has changed quite a bit, that we won't see quite the same animal spirits that we've seen in the past. One thing that is set up for it to take over, and I've been looking for a while, is that mortgage affordability position. Because in the last few years, as you said, affordability on the face of it has improved because values declined, but at the same time values declined, interest rates went up. And so mortgage affordability didn't really improve. And it was only in the last year where we've seen mortgage affordability get back to long-term averages. So what I've been saying is that in the last year or two, there's been some willing demand come out back again. People have been keen to buy property again because they've seen the decline stopped. They're interested again. They've still heard the positive stories, but they haven't actually been able to get that mortgage that's required to meet the vendor's expectation of what their property's worth. Now that mortgage affordability is back to long-term averages, that might say that there's actually a number of people out there who could afford to get that mortgage, that if there is some momentum upwards, we will start to see that growth come back. I still believe long-term, we're not going to see the same 6 or 7% annual growth rate that we've seen every year, year on year for 40 years on average. Like obviously not every year, but on average, it's been 6 or 7% value growth in property prices in New Zealand, which is pretty exceptional, right? We're now setting expectation that it'll be closer to 3 to 4% long-term. Now, you'll have phases that'll be more than that, phases that'll be lower than that. But there's a number of factors why that has changed, probably for the better. Now, many of that is land use. We've got a lot more better planning for building more properties in closer to town and supported by infrastructure. We've had significant change in household income in the last 20 years, particularly doubling of household incomes with both homeowners working. We've had the potential for tax change as well. I think now the conversation around, Labor wanting to bring in a capital gains tax at some stage, whether it's enough for this year, we're not so sure. But the big factor is, of course, long-term interest rates falling. Going from 20 or 30 years ago, 20% interest rates being normal to 5%, we can't see that decline or that scale of decline happen again. So if you look at those 4 factors as the main reasons, including, favourable tax position for properties, those 4 things can't happen to the same degree again like we've seen in the past, then that to me says we should expect less growth in the future. It's not to say we won't be through some phases that are stronger than that and weaker than that, but long term, I don't think those animal spirits will be quite as strong because of those factors. So it'll be an interesting one to see how it plays out, but that's us sort of tempering expectations on that future growth rate.
And Rach, how does that kind of align with your kind of thoughts?
The global REITs are pretty well positioned. There's limited supply coming in the market. Property vacancy rates are very low, and you're starting to see rental growth coming through. So the global REIT sector's currently got a dividend yield of about 4% and growth of about 4%. So it's probably a bit more than what you're expecting in New Zealand for the New Zealand residential, sitting at about that long-term average of 7.5% to 8%. I just wanted to ask you, Nick, how much of the affordability is affected by the rates? Like New Zealand investors have been slammed with much, much higher rates and insurance costs. You talk about mortgage affordability, but it is more than that, isn't it, for a residential property?
Yeah, absolutely. I think, it's a very simple measure. It is literally what is the typical mortgage payment going to be, what proportion of income is required to service that, based on the median house price.
Yeah,
so there's no other cost taken into account, which you're absolutely right. That is the mortgage payment, but the associated cost of owning a house are so much greater right now because of those rates, insurances. If you're having to make adjustments to your house or improvements or remedial work, that costs you more as well with the cost of builders and those costs associated too as well. So I think that, yes, you're right. On the face of it, mortgage affordability looks good, but home ownership probably hasn't improved as much as, when you look at all the costs that have come into it. So it's a good point in terms of that will be yet another factor that will just limit what that demand growth might actually look like.
And Nick, you kind of said you're seeing at that lower end some investors start to nibble away at the market again. What are kind of current yields looking like?
Yeah, we don't. The way we track yields is the median price of everything and the median rent, right? Yep. Now, that isn't really accurate of what the actual yield will be for a property investor because they don't buy the normal property, right? So the median or the average yield across the country is like 3.8%, which sounds terrible, and it is.
And that's gross?
That's gross. But what really is most important is how that compares to the past. And that's the best it's been for a good 3 or 4 years now. So I don't think the rate itself, 3.8%, is actually the truth. It probably is closer to 6% for many investors that are buying a property. But what we're looking at is how much has it improved now compared to the past, and where are you going to get better yield based on those averages in certain cities compared to others. And that's where we're seeing greater yield in the likes of Christchurch and Dunedin compared to the likes of Auckland and Wellington, where things aren't quite as strong from a rental perspective. So I think those are the figures to pay attention to. The raw number itself on our measure probably isn't the ideal figure, but it's more about that historical context and the regional comparisons that matters to us.
Yeah, and look, I think it was a good point you said earlier just around the changes in yield, from what we've seen and the, ability of that to go on going forward. Because, something we think about a lot in any asset is actually your entry point matters a lot. You talked about it earlier, 2021, getting into the property market. It's looking quite different than, if you bought in, say, the early 2000s or in the 90s. And, for us, that impacts any number of asset classes, right? It's why in 2022 we saw that big sell-off in tech stocks, long-dated cash flows. And, if you've got a higher discount rate, your value's kind of less today. So, I think that's a really just good investing lesson overall, is that, your entry point matters. You can't just buy, shut your eyes and think everything will be perfect in 5 or 10 years, because, I suspect those in 2021, they might be, luckily we were upgrading property, so wasn't as quite bad for us, as say if we'd bought our first home in 2021, that would have been, quite a bit worse. Look, I'd really like to talk a bit about the election, and it kind of feels like housing was the hot topic of elections gone by. And, this time it probably feels like less of a topic. But talk to us about, is there an impact that the election might have, including just on the fact that there is an election? Because sometimes election year, people can actually, sit on their hands a little bit. So what do you think we're kind of going to see?
Yeah, I think that's the number one thing, is that election brings uncertainty. And that means that people aren't going to make a big decision, a big financial decision in that time. So I think in terms of transactions, we'll likely see them slow down in the lead up to the election. The scale of that might differ depending on what the election results looking like. So if the polls are showing more likely to retain a national-led government, then maybe you don't see the same reduction in transaction activity. If we're potentially going to see a switch, or it's pretty close in terms of government, then you might see people pull back a little bit. Although you could also argue that if it's looking like we could have a Labour-led government who are getting kind of public approval of bringing in some form of capital gains tax or comprehensive capital gains tax in that next cycle, you might see some people bring their purchases forward because they want to get in ahead of that valuation date, which might be as soon as next year or the year after. So it's very variable depending on that. I think it's a really interesting point about, it has been a key factor. It's a constant thing, right? Like housing has so much influence on us as beings, and our well-being, whether it's health outcomes. Housing is just so important in so many ways. So it is going to be a consistent topic. The way it's talked about might change a little bit. I think one thing that's been great to see over the last few years has been the maturing in terms of mostly an agreement that we need to continue to build more property. Particularly the current Housing Minister, Chris Bishop, has been very strong on saying we need to build more, we need to intensify, we need to provide the infrastructure to build that. And been really strong in saying, he's happy to see prices not increase at the same rate they have in the past. And generally, I think you'd get agreement from Labour in terms of we need to see that improvement in affordability. So maybe the fact we've got some agreements on both sides means that conversation around affordability and building more won't be the key factor. I think the thing that might start to come through, and it's very relevant based on the last few weeks with, all these bigger weather events as well, is the impact of climate change on our housing, where we live, the resilience of our properties, how insurance are covering us, the fact that some places, some insurance companies won't cover those areas as well. So I do wonder about its more climate change policies as it relates to housing might become the key topic, as opposed to housing affordability, supporting first home buyers with grants or something like that. Like that's probably drifted away. It's more about moving into that climate change space and how it relates to housing.
Okay, so it looks like New Zealand-wise, we're, perhaps looking at an okay sort of a year. Rachel, globally, are things starting to look rosier?
Yeah, Chris, I think the sector is starting to look rosier. the sector's currently trading at or below replacement costs. So I think you're going to see a little bit of corporate activity, which will underpin prices in the future. And overall, you've got the vehicles have got strong balance sheet. There's a limited supply coming on. You've had construction costs increase by 30 to 40% in the last 5 years. So that is, makes new development much harder to stack up. And you're starting to see rental growth in some vehicles. So I feel like globally the sector is in a stabilisation period, and that there'll be some pockets of good growth in some of the sector areas.
Look, normally we go through and ask a long list of questions to guests, but given there's two of you on this episode, I'm just going to ask you one question, and it is, tell me your favourite book or podcast. And the reason I like to do both is I've got young kids. I don't get to read books as much as I used to, so I listen to a lot of podcasts. So maybe Nick, start with you. Favourite book or podcast?
Yeah, no, Chris, you're speaking my language because I've got young kids also, so podcasts are my thing, to the point where we even have our own, of course, at Cotality. So got to give that a plug, the New Zealand Property Market Podcast, where we catch up weekly on what's happening in the market. Outside of our own, which, would have to be my absolute favourite, I suppose it probably drifts towards my sports leanings as well. Do like my football in particular. And what I'm really enjoying recently is the Football Fever one, which Jason Pine does. And generally each week he and Michael Burgess just catch up about what's happening in the A-League at the moment. So particularly for my Wellington Phoenix, the women going very well, men doing so-so. They also throw Auckland FC in there, though you can skip that section if you're like me and aren't such a fan. But that's my other one, is to just hear what's going on in some of the background of those football teams.
Awesome. That's fantastic. That's the exact sort of podcast that I'd like to tune into. Both of them, of course, the Cotality property and the Phoenix one. Rach, what about yourself?
I don't actually. I used to read a lot of books, but with a youngish family, I got out of that habit. I'm probably more of a Netflix kind of a person, and so my favourite show would probably be The Bear, or Brilliant. I've been watching another one called Shrinking on Apple, which is light entertainment.
That's one of my absolute favourites as well, Shrinking.
Oh, really?
So I totally agree, yeah.
Thanks so much, guys, for coming on the podcast. And sounds like we got some good listening and watching to do over the next few weeks. And that does it for the latest Aurellan podcast. If you'd like to learn more about Aurellan and what we do, please visit us at aurellan.com or sign up to us on LinkedIn. Thanks a lot. Thanks for listening to the Aurellan podcast. Everything we've shared is general information only, not financial advice. If you'd like guidance in your own situation, please talk to a licensed financial advisor.